Hey, how's it going, everybody? So recently I launched a poll to collect questions from viewers, and I got one really interesting one that's really applicable to a lot of people today. So we're going to address it. And their question was, what should someone be doing if they're close to retirement, say within 5 years, and the market is in a downturn? So this video, we're going to address that question. Markets are obviously something that we cannot control. I know a lot of the industry and people are focused on investments and returns, but there's so much more that goes on beyond just investments and what they return each year that you can actually do to help improve your financial situation. So I'm gonna give you a couple of quick tips that you can apply today to make things feel at least a little bit better, despite what we're seeing all over the media and what the markets are showing us. All right, so tip number one is to remember that we need to focus on the decades and not the days. Now, going day to day, yeah, things can seem scary. If you look at a market chart, you're going to see that it goes up and down. There's these really big swings. But if you zoom out and look at decades, go back to 2010, 2000, 1980, you're going to see that the market overall has gone up. You're going to have these blips, of course, but if you look at going back 20, 30 years, those blips don't seem like much now, do they? So in the moment, scary for sure, but overall, in the long run, the markets are returning positive returns. Remember, we need to be long-term investors. That's how you get rewarded with the market. We need to focus on the long term. Now, your focus on long term doesn't end when you get close to retirement or even in retirement. You still need to have exposure to the broad markets to help your portfolio continue to chug along and grow and sustain your retirement income and have money left in events that you need in the future, or if you want to pass money down to beneficiaries. So it's always important to keep a long-term focus. Don't get wrapped up in the short-term day-to-day things. Tip number two, ignore the headlines. Markets and the media love to thrive on fear. Fear equals more clicks means more eyeballs, more advertising sales, things like that. Ignore it. Markets in a recession, the Dow sinks, 1,000 points, things like that. They love writing these headlines to get you to click and buy into it. Don't worry about it. Focus on the long term. These headlines are going to soon be a thing of the past, just like they were in 2020. Everything seemed like the world was coming to an end there. Since then, the market's gone up over 50%. So it's one of those things you got to keep focusing on the long term. Don't get caught up in these headlines. The next thing to focus on is remembering to stick to your plan. If you have a plan in place, stick to it. Don't deviate it or suddenly make investment changes just because you think something's going to happen in the future, or you read some headline, or you saw someone talk on the news, or whatever it is. You need to focus on the long-term situation as always, and your plan. You make sure that you stick to your plan through thick and thin. You cannot bail on a plan just because the markets go down. A good plan should account for all of this. You should have that part built into your plan so that when these things happen, which of course we know they will, and they'll continue to happen throughout your retirement, that there is no time to panic. My clients that I've been working with since 2015 when I got into the industry have been through a couple of these downturns already, and we've put these plans in place. So even despite what's happening in the market, they can still retire this year. They're still on track to retire next year, and we don't have to worry about selling at a loss because we put proper plans in place to account for these situations. So make sure you stick to your plan. Don't have a plan? Then maybe it's time to get one. It's never too late to start having a plan for retirement. The worst thing you can do is just put it off to the side and wait and cross your fingers, hope everything works out. Most times, not going to happen. You want to make sure you have the proper plan in place. So the best time to get a plan is today. The next best time is tomorrow. So don't wait on these things. You want to make sure you have a proper plan in place. If you're thinking, hey, I don't really need an elaborate plan, I don't want to move my investments, I don't like talking to people, hey, that's fine. There are plenty of financial advisors out there that you can just pay them for an hour. Hey, look at these things. I have these questions. Can you answer them and give me your best ideas? Just pay them for their time, collect their ideas. You don't have to worry about buying some big expensive plan or moving a bunch of assets to them. It's just a simple information getting setting so you can know you're on the right track or not, and you know what adjustments you need to make. It's the same strategy I employ when I meet new professionals such as CPAs or attorneys. I'm always happy to meet with them, pick their brains for questions, and of course pay them for their time, because I know if I just get one or two good ideas from them, it's gonna be well worth it for my clients in the long run. So I'm not afraid to shell a couple $100 for their time to get some of the best ideas to help make impactful moves for the clients. So same thing should be applied when you're looking for financial advisors. Go ahead and pay for their time, get some better ideas and a professional opinion on your situation, and you're more than likely going to come out ahead in the long run just from this move right here. Next action step you can take is if you don't already have an advisor, go ahead and get one. Your advisor is really what stands between you and bad ideas. So all of us will get emotional, and from time to time, especially when the markets are down, we get emotional. We think, hey, we need to take the cash out. Or maybe I've got to move all into bonds or something like that. We always have these ideas of what we think is going to work. Maybe we heard it from friends or, again, the media or something. We're like, oh, I'm going to do this with my money. Consult a professional for doing that. The advisors a lot of times will be there to help you determine if it's a good move or not and help talk you off the cliff. So don't hesitate on getting an advisor if you don't already have one, just for the sheer fact of the emotional coaching alone. If all they did was tell you to stay in the market in 2020 when we were down over 30%, looking back now, you'd have been up even with the current market downturn. So that advice alone would have been worth thousands, tens of thousands, even $100,000 to you. So advisors are often misjudged a lot of times and judged on their investment returns. Now, investment returns, the market's going to do what it's going to do. Good advisors go beyond just looking at your investment portfolios, and then therefore emotional coaching, as well as just other well-rounded financial planning topics like taxes and such. So you want to have to make sure you have an advisor in place for, at the very least, just to bounce ideas off of, so you know that you don't make a mistake that you're going to regret down the road. All right, now I got 4 other actionable steps you can take today to help you feel like you're actually doing something despite having no control over what the market's doing. So tip number 1, go ahead and review your P&C insurance. That's your property and casualty insurance on your home as well as your vehicles. So oftentimes, especially when we get closer to retirement, we're peaking our assets, right? We have several $100,000 saved in Plan 3 or DCP and 403Bs, right? We accumulate all this wealth. We want to make sure that we're not exposed by being underinsured on our property or our vehicles. Now, a lot of times when people come to work with us, we ask for their vehicle statements for this reason. And numerous times I see people running the minimum limits because they don't want to pay for the cost. They don't see the value in it. So they're literally running $25,000 of coverage, the bare bones minimum thing. Now, question is, if you were getting in an accident with somebody, and God forbid it be an attorney, is $25,000 going to be enough to cover damages and healthcare bills, especially with today's rates? Probably not. And if it was accident bad enough, wouldn't they rather go for your Plan 3 account that's worth, $300,000 or $500,000 rather than the $25,000 you have from your car insurance? Probably. So one of the best things you can do is review your coverages, and if your assets are more than what your liability limits are, you might want to think about increasing those. You want to make them take the car insurance company's money, not yours. So don't feel bad about shelling out extra money for this protection, because chances are, if something bad were to happen, this would be a good use of your funds to help protect your money as well as your family's money in the future. Now, if you've already maxed out your car coverage limits, you can look into what's called an umbrella policy. An umbrella policy is a liability protection that covers both your vehicles and your house. It's one big umbrella, right? It covers both of them for just one premium cost. Usually these aren't too expensive, and they usually sell them in increments of $1 million. So I need an extra $1 million or $2 million of liability coverages. So that's another way to look to add more protection if you already are running at the max legal limits in Washington State. Next action step you can look at taking is look at your tax planning. So a lot of people kind of overlook this tax planning thing, think they have a CPA and think it's all good. A lot of CPAs are there to prepare taxes, right? You talk to them one time a year. Other than that, they're not actively working with you and saying, hey, what can we do differently to reduce your taxes in 5 years from now, 10 years from now? They're just there to record history, right? So to speak, they're looking at the rear view mirror and not through your windshield. They're recording history of what's happened in the past, and oh, maybe you should have done this better, somebody doing that. They're not actually looking like, hey, when this age happens, you should do this. You need to have some tax planning tactics in place. A couple ones you can use today. Roth conversions are a really good thing that many people should consider. Why? For 2 reasons. Tax rates are lowest that they've been in a very long time. So if we can put money from a pre-tax asset and move it over to a Roth asset, that's what they call a conversion, right? Moving from pre-tax to Roth, that is a taxable event. So you are going to pay tax on the transaction. Money in the Roth grows tax-free. So if we're willing to bite the bullet at today's low rates, and we think or we have a feeling that taxes are going to be higher in the future for multiple reasons, then that might be a bad idea to consider. The second reason, because the market is down today, it's a good idea because when we move the money from pre-tax to Roth, all the market has to do is come back to even, and all the growth we got back is now tax-free. So it allows us to take advantage of not only the lower tax rates, but also the market being down, it gives you the chance to earn more tax-free income in the future. Second thing you could do, if you have non-qualified assets, so a stock account or a brokerage account, something that you open with extra money in your savings one time, you just kind of just threw it in there. It's not a Roth, it's not an IRA, it's just kind of money that got shoved into some type of account like that. That's what we call brokerage accounts. Those accounts have something called a tax loss or even tax gain harvesting that you can do them each year. So if the market's down like it is today, you could actually sell some of those investments that are at a loss, and you can use the loss to offset either income on your tax return or other gains you had in your portfolio. So if you had a stock that you bought years and years ago and you have a nice size gain in there, you actually sell a portion of it off. The gain is taxable, but if we sell it for loss, we may be able to offset all of the tax that gain generated. Therefore, you owe no taxes on it despite having a big gain in that investment. So they're just little tax strategies that could be implemented. Now, if you're a rookie to taxes, don't feel comfortable doing this, go find a professional. You could try a CPA, see if they're willing to help you with this kind of stuff. Best bet, try to find an independent financial advisor that also does tax planning. They're going to be fully willing and able to help you implement these type of strategies to help you in the long run. Now, again, this has nothing to do with investments. This is tax planning. It's an added feature that other advisors are doing to help show more value to their clients, and you should take full advantage of it. If your current advisors aren't doing this, you might want to think about looking elsewhere to see whether value can be found and what else you're missing. All right. The last tip I have for you is looking at your mortgage payments. So if you're currently paying off your mortgage, the markets are down right now, you don't feel comfortable investing in the market for whatever reason, you could look at paying extra on your mortgage. Now, this actually makes more sense today than ever because our standard deductions are so high. Many people can't itemize before. In the past, you could itemize, kind of what you paid for your home, state and local taxes, things like that. Standard deductions today are so high, most people aren't taking itemizations anymore. They're taking the standard deduction. Therefore, you might as well just start paying extra on your mortgage. So if you have extra cash you want to put towards a mortgage, you can do it that way. Or if, like most of us, don't have the extra cash or don't want to put more money on the mortgage for a reason, you rather put it in the market and buy while it's low, you could just take your current mortgage payment and split it up into a bi-monthly payment. So you're going to still pay the same thing per month, but we're going to pay on the 1st of the month and the 15th, right? You're going to pay 2 payments per month. Now, what that does for you is because we're paying every 14 days or 2 weeks, you're interrupting the time period for the interest to compound, right? So when we pay monthly, we make the payment, the remaining balance gathers interest for the 30 days, and then we pay it again. If we can cut them off halfway there, they're only going to accrue interest on that balance for 14 days or 2 weeks, and we're going to pay it down by a little bit. Then the next 2 weeks, it's going to be slightly less than it was before. So this little tip can actually save you a couple $1,000s in the long run just by going from a monthly payment to a semi-monthly payment. So that's something you have to check with your lender to see if that's an option, but it's not a bad way to, without changing anything or putting up any more money, to save some money and interest in the long run. And very last action item, if you haven't already checked out our investment service that's specific to Plan 3 and DCP members, be sure to check that out. In this service, we basically tell you what to buy and what to sell in your Plan 3 and DCP accounts. It takes away all of the guesswork and the stress. You can kind of dial in what your risk level is, and we'll tell you exactly what to do each quarter, or if and when the markets do certain things, we'll alert you. So we have multiple different ways you can get set up in that. Be sure to check that out. The link is in the description below. I hope you found this video helpful. Leave me a comment with any questions that you have. I'll see you guys next week. Remember that your future depends on what you do today.